11/17/2012. Here we are gathered before Thanksgiving. This following coming up week, we're going to be looking at the monthly level of the S&P 500. As we connect the bottoms from the 2009 lows right to the undercut of the 2011 lows, which was 1 year ago, at around this time, it was 10-1 actually, but we started putting bottoms in on 12-1 as it started to come up to confirm them. We rallied up, we corrected, and we made 5.5-year highs in the S&P. The reason for the monthly chart and the reason why this one is more important right now than any other one is because these monthly moving averages, such as 10-month, has come into play. We've undercut that 10-month moving average. We started out at 1434 on the high of 11.1. We hit a low as of yesterday on 11/16 of 2012 at 1343.35. We closed at 1359.88. The 20-month moving average, as we've always said, it's going to come into play at 1329.27 on the S&P 500. Now, these numbers can fluctuate a little bit. This is the time of year where we're supposed to get rallies. We have the fiscal cliff. I can tell you that since we've been involved in the S&P rally, we haven't undercut the 10-month moving average. Once we got above this 10-month moving average, which was on 11.1 or 1/1 of 2012, that's that January that we started out in the calendar year, we have not been below that 10-month moving average for that whole calendar process. We are now breaching it. We have closed below the 10-month moving average, which will now serve as a wall of resistance at 1384.31. The ranges would be from the 20-month moving average at 13.29, and the resistance levels will remain as follows: 13.84. So when we have undercut a monthly moving average, it's much more significant than the weeklies charts. I would say right now that the fiscal cliff and whether they're going to do the right thing in Washington, who knows? But I can tell you, even outside of all of that, historically speaking, we have been in an overbought bubble, because this is what this whole move was in calendar 2012, right up here. It was a bubble. I can also tell you, even at the correction levels that we currently have, we're still, in my view, overbought in the S&P, because it's still at 81.8% DS, which historically is a very high reading. The corrections that we're experiencing is to be very mindful that when we hit the 20-month moving average at 1329 is where selling would escalate. Because what we're going to do is that this trend line right here at 1300 on the S&P is the very vital or very significant or very crucial support level. As you sell through a 10-month moving average, what we take a look at is where they flatten out mathematically. If they start to turn over, and if we come down to the 20-month next week, will be a very light trading week. It's Thanksgiving. Generally, with a short week, you rally because there's not a lot of people around. A lot of people are taking that time off. And we're going to see what the broader exchange model does. And until there is a resolution, any dips that are bought need to be sold at resistance level, because these are not bull trends. These are beginning bear trends. It's just the first phases of them from the calendar 2012. As we end this whole year, by December 31, we will remain range bound, and the 10-month moving average will be significant resistance at 1384. Granted that the S&P 500 closed up 6.55 handles because in the shorter macro term, we are oversold. In the very short term, we will be looking at various positions that once they do go up to resistance levels, that we would look at below the market put options. I can tell you that the total range so far from 11.1 to 11.16 has been 90 points in the S&P. That's from the top down and or the bottom up, but it's been 90 points. 90 handles on a monthly level. We will talk about during this upcoming week as where this S&P 500 is going to go. If there is no fiscal cliff resolution from the White House with the higher tax rates, we will break down, and as we move through calendar 2013, this S&P, where it started right here at 1100 just a year ago, in the wintertime of 2011, we got down here to the bottom, and then like I said, we're coming up, we had corrections, and we have a 2-month reversal. We had a 2-month reversal here and a rally to 5.5-year highs. It would take an act of Congress and everything would have to go right for this bull to stay intact. The chances of that happening are slim to none. One of the things that we'll be looking at is how the retail season is affected. Another thing I will tell people that there are 500 companies in the S&P 500. If the yields on capital gains tax goes higher, that means that there's going to be more selling. We've had tax selling in the S&P so far. People are starting to sell because of the tax increases in 2013 that would go into effect automatically January 1. Now, in bull trends, they got support levels for a while. However, it's mindful to know that any move up on resistance levels, one of the things that we're going to be looking at is where this top of the bar, where the 10-month is right here, which is 1384 resistance and support levels. So support levels are going to be 1329 and resistance levels will be exactly the following, 1384. They'll fluctuate a couple few points here and there on the monthly chart. I can tell you that if this thing does not go right in Washington, D.C., the 2010 lows will, the market will, you will break down. If there is no resolution, you will print right back down here. You start getting down to the 100-month moving average at 1238 if you break through here. So a lot is going to be dependent on what they do in Washington. But I will tell people, if we go off the fiscal cliff, everything that happened in 2009, all the stimuluses and everything that's happened in this country will be at jeopardy. I can tell you another thing, that when you enter a new bear market, meaning that we've had a great bull run, but once you enter into that bear market, it would not be abnormal by 2014 mid-year that you're all the way back down here where it all started in 2009. The problem is that we don't know exactly what those people are going to do. But I do know what happens if they don't do the right thing beyond a reasonable doubt. And you will sell down on the S&P. Nothing will go straight down. But when we're forward looking out in 2013, we know that the earnings cycle, the taxation cycle, all of these things are not prone for a bull. They are prone for a bear. So it's very important to understand on the shorter macro level that there's going to be increased price volatility. There will be support levels in the broader S&P 500. It's had a fantastic bull run every time that I come off of this diagonal trend line. When I come right here, it's going to be right above 1300. I break below this trend line right here, then the next area of support levels are going to be right about over here. And this is going to be right around 1235 on the S&P. That means from where the S&P is closed on this Friday before Thanksgiving, if things don't go well, forward looking, there is another 100 handles to go lower in the S&P 500. Everyone is on the sideline because of the uncertainty. I'm giving the major update right now. I will get together on a shorter macro term on how this S&P will work on weekly and daily charts with the MMT crew. The thing about it is, money is made on the downside, money is made on the upside. The shorter macro levels are, we are oversold. The broader part of Wall Street is looking for government resolution. We do not get it. We will continue the selling all the way back down here to where the bull run started. The bull run started right here on an up note. The bottom of that bull run right here is about 1259. This is this low monthly bar right here. So having said that, when we come across this, this will be the first little area of support. It's going to be this monthly bar right here. And I just do that diagonal 10 line right there. So this is the lower end, and it is also slightly below that 20-month moving averages. When you start breaking monthly moving averages, selling can increase and get quite nasty. It's all going to be about how the consumer is spending this holiday and what would happen and why the unemployment rate would go higher. Because big businesses are not going to hire. They will not. They will keep cutting, they'll keep cutting, and they'll keep cutting, and we already have evidence on how many jobs have been cut during this calendar year, forward-looking going into 2013. Basically, there's the support level, and this is what we're going to be looking at on the year-end closing trade, is by December 31st. Where are we at if we hit these support levels and or simply sell through them?